Hey guys, welcome back. In today's video, we are talking about the AMC new expansion, the increased volume, how shorts are preparing to unwind, and many more in this video. First, we take a look at this. AMC Entertainment will open 65 ScreenX and 4DX cinema auditoriums worldwide, including for the first time at AMC locations in the US. So ScreenX is a multi-projector system that creates a 270-degree panoramic viewing experience across 3 screens. And this is obviously what we're going to see, and it's expected to complete by 2027. And so as far as how AMC is going to expand its businesses, how they're going to obviously increase the attendance of viewers, this is how they're doing so. And remember, this is worldwide, but also including the US. And it's very important to note that because as we are seeing the box office obviously improve and increase in the US, one of the biggest things is to obviously fight for that market share. And that's exactly what AMC is doing. We already know that not only is AMC the biggest theater in the US, but if we have multiple theaters, but also give out the best equipment, the best viewing experiences, obviously the best food, the best beverage, etc., then that's how we're going to attract more attendance. And by attracting more attendance, obviously that leads to more revenue and that leads to more profit. And that's how we grow fundamentally as a company. And so going into the next few years, obviously what we're going to be seeing is this. And this is what we talked about with how AMC is growing, how AMC is going to be making more money, and why AMC is on a steadily climb as we see it making more business decisions like this. And so this is obviously what we want to look out for. This isn't going to be the only thing for AMC, obviously for the next 2 years. But when you pair this up with other things they have in store, with other things that they will do, and the reduction of debt, then we can see how AMC is going to be in an extremely healthy position. But also what we're seeing right now, and this is obviously based on the fundamentals that's obviously happened recently as well, is for GME. Now what we're seeing is the volume for calls to obviously be having a major increase. Now there's a big reason for this. Well, firstly, we can see that the GME short share volume has gone up drastically where we're looking at this. Now what we are seeing is a drastic increase, but it still doesn't obviously reflect the full amount of short shares there are, because if you also take a look at this, what you can see is 2 comparisons. Firstly, the GME short volume in comparison to some others, like you guys can see here. And secondly, is about understanding just how much, if we can see SPY being shorted that much, then you could have understood in comparison how much GME can obviously be shorted to as well. When we consider how much volume there has been, when we consider how many shorts there has been, how many synthetics has been created, you obviously know that volume is at a higher scale. And so the focus isn't to say that we are seeing the GME short volume of exactly 9.2 million, but rather is to understand that this sharp increase is showing how the shorts are, of course, doubling down. The shorts are increasing the position on GME. Now, there are some clear reasons for this. Firstly, we can also see plus 420% short volume alert. Again, just further highlighting how much there is. And so how much short does it take to get to the center of a GME squeeze? The world will know soon. And so what we're seeing is the share price going up, but yet we're seeing the share volume increasing along with that. Now, we obviously knew that GME went up 15% yesterday. And the reason for that was because they beat earnings and they said that they were going to invest into Bitcoin. Now, GME actually dropped 20%, but the share volume increase actually started yesterday and not just today. And what we have to understand is why that's happening. Now, we are going to be talking about it, but we'll cover that later on in the video. What I wanted to go over first, before we just talked about, in terms of the new thing that GME has done, is taking a look at this. Interesting timing for the DTC to amend the recovery and wind down plan. And what we're seeing is this. So they're saying the rule filing will amend the DTC recovery and wind down plan. Now, what that is that the wind down plan is comprised of 2 primary sections. The recovery plan, which sets out the tools and strategies to enable DTC to recover in the event it experiences losses that exceed its pre-funded resources. And the wind down plan, which describes the tools and strategies to be used to conduct an orderly wind down of DTC's business in a manner designed to permit the continuation of DTC's critical services in the event that its recovery efforts are not successful. And so it's obviously a two-part process. Now, the first thing, and this is something that we talked about, is the pre-funded resources. Essentially, we talked about that the firms who are in the DTCC, they've all put up their collaterals, and this collaterals is used together. So if one fund were to fail, then not only will they use up the collateral they put up first, but they will use the other collaterals that other companies who are also in the organization have put up. And that's why we've talked about why it's been an extremely long process to beat the shorts, because in the DTCC, for example, it may comprise of 7 firms, but only 3 firms is shorting AMC. And whilst those 3 firms are losing out money, they also get the other 4 firms to be covering them with the collaterals. And so that's why it's been a long process, because we don't just have to beat 1 or 2 firms, we have to beat every single firm. And even the firms who aren't shorting AMC, they're still somewhat helping out these firms who are shorting AMC because of the collaterals that they put up. But as we've seen that they're changing the wind down plan, which is a plan that is already considering not only the collaterals that the individual firms put up, but what every other firm puts up as well, aka the pre-funded resources. So in my eyes, this is a different wording that even when you consider every bit of liquidity and capital that's been put up as collaterals for the margin in the DTCC, we're actually seeing how when things go bad, when the positions that we have always monitored actually go sour, and when they explode, all this money won't cover it. And so that's what we talked about. And again, when we understand truly what's at stake, when we understand the amount of money that's involved with these AMC swaps and shorts, with these GME swaps and shorts, and the FTDs and the tokens that obviously exist out there for both AMC and GME, we know that the money are not only in the hundreds of billions, but it could potentially be in the trillions. And if you want to know, in terms of the DTCC, what we have seen is that hundreds of billions and trillions are not actually put up as collaterals. And so they obviously see that. Now, the second step of their plan is obviously talk about the continuation of DTC's critical services in the event that its recovery efforts are not successful. So it's going back to what we talked about in the start, even when, essentially they don't have the money, and when everything blows up, they won't have the equipment needed, they won't have the resources needed to obviously recover everything. And what we are seeing right now is essentially how they're trying to prepare themselves for what's about to come. You can see truth hurts, there it is, straight from the source. On March 25th, 2025, the DTC officially proposed a rule change to amend their recovery and wind down plan, a blueprint for what to do in the event that experienced losses that exceeds its pre-funded resources. This means that they are actively preparing for a worst-case market-breaking event. This isn't just a standard procedure, it's the financial equivalent of checking the parachute mid-flight. And when you zoom out to the bigger picture, what we have is obviously GME volume ripping, short interest through the roof. We also have derivatives exposure hidden in the cracks, DTCC's own margin systems blinking red, AMC FTDs, AMC naked shorts, AMC fundamentals. We have all of these things kicking in right now, and they're checking for whether or not they can survive, whilst understanding they can't survive. So to me, it seems like they already know that they can't survive this. It seems to me that they already know they can't prevent the squeeze from happening. But what they can do is try and change these rules where potentially it will further delay this whole process, or it gets them out and it only makes the firms who actually got involved pay. Now let's talk about the convertible bonds. Let's talk about what GME has done. So GME has proposed a private offering of 1.3 billion of convertible bonds. Essentially what it does is they're raising money to be buying more Bitcoin. They're trying to obviously raise money to for themselves. Now, this is exactly what the news is popping for GME today. You could argue that the 20% drop is because of this. Now, I know some people don't want to link it because there have been times where shorts have tried to use the news to create an effect that's bigger than it thinks. So under normal circumstances, maybe the convertibles would have only dropped GME 10%. But because the shorts want to make it look like it's the end of the world, they are obviously higher in as well, and hence why we're seeing the drop at 20%. But what we have to understand is that essentially GME is trying to raise more cash, and we have seen how, because GME has a massive cash pile, they've put themselves in a very good position. And so this is obviously a double-edged sword, because if this is done well, the cash that they raise with the investments that they make will put them in a very good place. But we've also talked about this, and you can see Investor Bigham's talking about this as well, is that if he were to fail, we're talking about the CEO of GME, if his decisions were to fail and he fails to use his cash correctly and he loses out on his investments, what it can do is that it can hurt a squeeze, because it can convert on the squeeze at the set price and either get a lot of stock or a lot of money from GameStop. And so that's what we have to watch out. But like I said, I don't think it's nothing to be, everyone's making it look like it's the end of the world. What I do think is a double-edged sword. I still think we should be on the sideline and see what happens. But yeah, guys, thanks for watching. I'll catch you guys next time.